Hey everyone, and welcome back to the channel. My name is Hamish Hodder, and today we're looking at Chipotle. Why does it always rhyme? Why? It's always like Q&A in the month of May, or today we're looking at Chipotle. But we're looking at Chipotle, and this will be an interesting company to look at because it's a company that is followed by one of the guru investors, and that being Phil Town. So Phil Town is someone that I certainly look up to. It's someone that I learned from very early on when I was investing, and I think a lot of you out there would have learned from his books. They're very good at breaking down complex topics into sort of simpler. He's very good at explaining very complex topics in simple ways, and he actually has invested in Chipotle in the past successfully, and there's actually a great video on his channel talking about that, which you can go check out after this video. I'll probably leave a link to it down in the description below. But in this video, I'm essentially going to be going through my 4-step process for analyzing businesses and making investments, and that process goes through by first looking at the business itself, looking at its industry, its competition, that sort of thing, seeing if we can understand this business and whether or not it's in an industry that supports long-term growth and that will support a good investment. And then we do economic moat analysis, which is where we're looking to see if the business has any kind of long-term competitive advantages within the company. Then we look at management in a number of different ways. We're looking at how skillful they are at investing, how honest they are to shareholders, and how good are they at managing their debt and keeping debt to low levels. And then the 4th step is, of course, we need to calculate how much cash the business is going to put in our pocket, because that is the most important thing at the end of the day. How much money are we going to get out of this company? And therefore, how much are we willing to pay? So that's what you can expect in today's video. And if you do enjoy it and you're not a subscriber, what are you doing? Hit that subscribe button. Join the team. And if you already are subscribed, thank you for being a subscriber. You're one of the loyal ones. Drop a comment down below what you think about this video. I would really appreciate that. But for now, I think we should just get straight into this video. And let's start by talking about Chipotle's business. What is Chipotle? So Chipotle they're a restaurant chain, and they're a restaurant chain that operates in the fast casual segment of the restaurant industry. And this might be a segment that you might not have heard of before. You've certainly heard of fast food. It makes up about, I think, just under 50% of the total restaurant market. We then have full service dining, which again makes up a pretty significant amount, above 40% of the market. And then in between those two major segments, full service dining, where you sit down and someone comes and takes your order and it's fresh food. And then on the other end, we've got fast food, where you order at the counter and it's usually pre-prepared, it's frozen food. And right in the middle, we have fast casual, and this is a small segment of the market. It makes up under 10% of the restaurant market, but it essentially aims to combine the two. It combines the sort of fast food aspects where you go to the counter to order and the food is prepared pretty quickly, but it also combines fresh food. So food is prepared on site, and that is where Chipotle sits. And they are actually one of the first companies that started this segment in 1993, and that was actually when Chipotle was founded, all the way back in 1993. So it's actually not that old in terms of a restaurant chain, but in the last, 25 years, they've been able to build out over 2,500 restaurants across the United States, and they have a couple overseas, and they actually have a couple of non-Chipotle restaurants as well. So this company has grown really quickly, and it's no surprise. People love their food, but this company certainly doesn't come without controversy, and we'll talk about that as we sort of go towards the intrinsic valuation part of this, because there was some problems that happened in this company a couple of years ago, and that was actually the time when Phil Town was able to invest in the company when the stock price was suppressed. So one of the things that I like to do when I'm making these presentations for you guys is talk about the key business indicators. Now, a lot of people don't talk about these, and these are really important. So key business indicators are sort of unique indicators, unique numbers that we can look to find out about the performance of a business. And the reason why they're unique is because they differ from industry to industry. They're not the same across the board. While all businesses on the stock market have revenue numbers, and they have profit numbers, and they have equity numbers, not all of them have these unique numbers that can tell us actually about the particular business in its industry. So there's always a ton of them for each business. There's usually 5 to 10 different ones that you could look at, but let's just zoom in on one particular one for Chipotle and for restaurant businesses for that matter. And that particular key business indicator is restaurant openings. And it is exactly what it sounds like. It's the number of restaurants that a company is able to open in a particular year. And there's a bunch of different factors that influence this. That influence this and their ability to find available sites, because essentially they've got to be able to find good locations that are going to be good for the restaurant, and they've got to be able to buy them at a cheap price while there's all these other restaurant chains and individual restaurant owners who are competing for those great locations. So that is one of the key aspects that we need to look at. We need to look at the ability of the restaurant chain to open more restaurants. And if we're talking about Chipotle, they have been able to do this very successfully over the past 25 years. They've opened, as I said, over 2,500 restaurants in the United States, which is a lot. And if I just draw a comparison here, Texas Roadhouse, which is another company that I think is really great in the restaurant industry in a slightly different segment, but they were also founded in 1993, yet they have only been able to build about 500 or 600 restaurants. So putting those two side by side, Chipotle has grown at almost over 5 times as fast in terms of restaurant openings. And that is a huge contributor to increasing the revenue and cash flow streams of a business. Before I move on, guys, I know a lot of you guys might be interested in learning about this 4-step process that I go through in these analysis videos, because if you've watched a couple of these, you'll notice that I go through the exact same process, and it's because I pretty much apply the same process to every business that I'm analyzing so that I can make investments that make above average returns. So if you're interested in learning a little bit more about that process, I actually put together a free 20-minute training video on my website, which I'll leave the link to down in the description below. It'll probably be the first link. So go check that out if you're interested in learning more about that process. But moving on now from looking at the business, in sort of the overview of the business, let's have a look at the economic moat. Let's see if we can identify if Chipotle has any kind of unique advantage within the business. And the main advantage that you will probably first identify in a company like this is their branding, is the fact that customers specifically seek out Chipotle because they love their food. And first, we need to do a qualitative analysis, which is essentially where we try and identify an advantage. We just look to the business and we look to the different types of moats that companies have, generally branding moats, networking effects, toll moats, and we see if any of those apply to this business. And for Chipotle, a branding moat certainly does apply from what we can see. But looking at a business and just identifying it is not enough. We need to see that it's backed up in the numbers. So let's go and jump over and have a look at the growth numbers of Chipotle over the past 10 years and see if they indicate to us that they do have a sustainable competitive advantage. Now, at first glance, Chipotle's numbers look terrible. If you just looked at this and you asked someone to tell you whether or not they thought that these numbers were good, most people would say they're terrible. And yeah, they look pretty terrible. But let's take it step by step and let's have a look and see what we can read between the lines of these numbers. So over the 9-year average, we can see that the numbers are pretty good. Sales growth has been about 14%. Then we have 5% for EPS growth, just under 10% for equity and free cash flow, and owner's earnings of 7%. Those numbers are slow, but they're not horrible. And if we look at the 1 year, we can see a pretty similar effect there. Sales growth just under 10%, earnings per share is very slow, so that's not a good sign. We have equity at about 6%, and then we have free cash flow and owner's earnings far above 10%. But then what is going on in the middle? So if we take a little bit of a deeper dive into Chipotle's business, we can find out what actually happened in those middle years to cause the numbers to look so terrible. So what's causing these numbers to look so terrible is what happened to Chipotle at the end of 2015. And what happened was a bunch of people at a bunch of different Chipotle restaurants got sick from E. coli bacteria, which is really, really bad. And not only were those specific illnesses really bad for those people, what happened was the media jumped on it and it got national coverage. And in fact, in Australia, we heard about this. I remember hearing about this back in 2016. And the problem with that is that it was so widely covered by the media that even when the smallest thing happened at a Chipotle restaurant, like someone slipped on the floor or someone got a cold from eating there or something like that, the media would jump on it and use it to talk about what had happened to Chipotle in the past. And as a result, their numbers got crushed in 2016. They were decimated. The traffic in their stores, people coming into their stores, was down 20% year over year, which is massive. Now, the company has been recovering, and as you can see from those numbers, from their 1 year numbers, you can see that their growth is starting to return to those levels that they were over the long term. But in the middle, those numbers look terrible because of what had happened in 2015 and 2016. So it's in a case like this where you can't just look at the numbers and look for the whole table to be completely green for you to say it has an economic moat, because I would form the opinion, and maybe you would disagree, let me know down in the comment section below, but I would form the opinion that Chipotle certainly has a wide economic moat. And where I get that from is because of their ability to grow so successfully over the past 25 years, and from just talking to people. People love this restaurant. And looking at those numbers, it looks as though they don't have an economic moat. And from my opinion, I would say, look at the long-term numbers. They're pretty good. They're good. And look at the short-term numbers. They're great. And those middle numbers are just representative of a short-term problem that happened within the business that hopefully will not severely damage the long-term branding moat that the company has. So I would say that even though these numbers don't look great, even though they look terrible, I would say that Chipotle does have and has demonstrated in the past that they do have a sustainable long-term competitive advantage. The third part of our analysis is to look at management. And as I said in the introduction, we need to look at management in a bunch of different ways. And I talk about all the different ways in that 20-minute training video. But in the interest of time, we will just talk about one, and that is their ability to invest successfully within the business. And the best measure of this is to look at the return on invested capital. How much free cash or owner's earnings or how much cash flow are we getting out of this company compared to how much they're investing? Because we want to see what kind of returns they're getting on their investments for shareholders. And Chipotle's return on invested capital has been outstanding across the board. All of those numbers are well above 10%. Most of them are above 30 or 20%, which is pretty insane. And even in 2016, when they had terrible results as a result of those E. coli outbreaks, their return on invested capital was still above 20%, which is pretty crazy. And essentially what that means is that for every dollar they invest, they're generating at least 20 to 30 cents back on that dollar, which is really high. And it means that if they can take those profits, that 30 cents that they generate, and put it back into the business and compound it over time, they will be able to quickly compound the cash flows for owners. And that means that we are going to be able to make more cash and get more cash out of this business over the long term. So the final part of our analysis is to do intrinsic valuation. And that means that we need to estimate the cash flows of this company, estimate what we're going to get back in each of the next few years, compile them all together, and work out how much we're willing to pay. Because at the end of the day, making an investment is just working out what we're going to get in compared to what we're going to pay out, which is when we buy the investment, when we buy the stock. So to do this, what we need to do is we need to estimate the cash flow growth rate of this company into the future. Now, what I would normally do is I'll pick a number of different growth rates to get a range at which intrinsic value likely sits. But in the interest of time, I'm just going to show you one growth rate and I'll show you one model of what the intrinsic value could potentially be. Now, of course, I need to say that this is not a recommendation. This is not advice. I can't give you advice based on your unique circumstances through a YouTube video, and I think that's pretty obvious, but I do need to say this. I am just showing you an example of how you could model this company's intrinsic value. The numbers could be completely pointless. You could put completely different numbers into it, and if you want to mess around with the calculator and try calculate intrinsic valuation for yourself, which I highly suggest that you do, then I have a free link to the spreadsheet that I used down in the description below. So go check that out if you want to actually model it for yourself, and you certainly want to be doing your own research and doing your own intrinsic valuations before you invest in any companies for yourself. So the growth rate that I picked for this model is 10%. And really that's just one of the numbers that I picked. Remember, I pick a range, and how I picked the range of numbers came from a number of different places. Their long-term sales growth, their long-term cash flow growth, their long-term earnings per share growth, their equity growth, the growth of the industry itself. And through that, I came up with a range, and one of those numbers was 10%. And then we have the starting cash flow, which is the cash flow for owners number that I calculated for the past 12 months, and there's a video explaining that on my channel if you're interested. But essentially, if you use those two and a discount rate of 3%, which is about the current 10-year treasury yield, then you get an intrinsic value for the whole company of just over $15 billion. Now, the whole company is currently worth, it costs about $20.3 billion. So this means that the company is overvalued according to this calculation. It means that if you were to invest now, you would be paying, if you were buying the whole company, you'd be paying $20 billion. And over the next 10 years, you would be getting back 15. So you would be getting back less than you put out. And essentially that means that if we're going to put a buy price on this, say we're looking at a 22% return, then the buy price is going to be about $4 billion for the whole company, which works out to be about $145 per share, which is vastly below the current stock price, which is over 700. And normally what I would do here is then go ahead and calculate the expected return. But because the intrinsic value is below the buy price right now, the price that you pay right now is above the intrinsic value. It's overvalued. It means that the expected return is negative. It's not even possible to calculate a positive expected return for this company. And that might surprise you, and it might be weird that that's the case. But I want to explain to you how Chipotle was a buy at some point in the past, or it could have been perceived as a buy, and it certainly was for Phil Town, who made that successful investment in 2016. And the reason is that the business today is producing about a similar amount of cash flow than it did in 2015. So remember, in 2015-16, the business dipped and now it's coming back up. So during that dip, their earnings and cash flows have sort of just gotten back to the levels that they were at in 2015. Except when that scandal was going on, the stock price was 65% lower than it was today. So you could have paid 65% less for the stock, for the exact same cash flowing stock than you could today. And that is when Phil Town decided he was going to invest, and that would have generated you somewhere between an 11 and 19% long-term return, whereas investing at the current price under that model, it looks as though you're not even going to make a positive return, or at least that conservative model is showing you that. And if you were going to make a positive return investing at the current stock price, then you would need the company to grow substantially more than 10% per year. So I hope you guys enjoyed this one, and I'm curious to hear your thoughts on Chipotle stock. I know that a bunch of you guys have been asking me about Chipotle stock in the past, so let me know your thoughts down in the comment section below. And as I said earlier, if you want to see more and you want to show me some support, then hit that subscribe button, hit the notification bell so you get notified. And if you're already subscribed, thank you very much, and just leave a like on the video. But I'll be back next week for some more videos, and I hope you guys enjoyed this one, and have a great day. I'll see you in the next one.